This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now here on Market Talk for this Wednesday, June 15th, our good friend Mike Zuzolo with Global Commodity Analytics is with us. Mike, good afternoon to you, sir. Hope you're having a great Wednesday.
Yes, thanks, Jesse. Having a great one. Getting a little bit of a break from the heat. Got some cloud cover. Very welcome. It's starting to really heat up out here in northeast Kansas. It sounds like west of me it's going to be even hotter, though.
Yeah, I know. I just drove through a lot of heat to get to Iowa here. A little bit of vacation time, but still doing the show. But plenty of heat we've seen the last couple of days, and I know that's a big storyline in the markets. We're going to talk weather, I'm sure, here in a minute. I want to start just with the Fed news real quick if we can. I know that we have the Fed talking here right now this afternoon as we're talking. Looking at that interest rate projection, they projected the 75 basis point increase today. What are you seeing and hearing from the Fed news, and how do you think it could play into the markets as we get into the back half of this week, Mike?
Yeah, I think the key right now for me, Jesse, to lay some groundwork was I was really trying to give clients and subscribers the mindset that the trading week for me really doesn't start. The weather market really doesn't start until we get past Wednesday afternoon and get to Thursday, Friday, because in part that was due to the CPI data from Friday needing to be priced in more this week, the PPI data from Monday needing to be priced in, and then the big guy, the Federal Reserve update. And they came in with 0.75 of a basis point hike. They are on a trajectory to go up to 3.5% federal funds rate by the end of this calendar year. And what they're doing is they're, in my opinion, sacrificing growth for taming inflation. And my contention has always been this is more cost push inflation. It'd be a lot wiser to bring the oil rigs back up to pre-pandemic levels as far as pumping. It'd be a lot better to see the weekly rail car loadings for energy loads to be even with last year instead of down 15 or 16% for crude oil and for unleaded gas and distillates. I think there's a lot on the supply side we could be doing in policy, and that this monetary policy is kind of a sledgehammer instead of a surgical knife. And I'm not picking on the Fed here because I understand they're under some pretty significant pressure, but I'm really concerned that we're not going to just go from a stagflationary market to a stagflationary market. I'm really concerned with this type of projection now that they're going to go from stagflation straight into recession. My fourth quarter expectation is still very much in play. And I'm really worried now about a deflationary mindset heading into 2023. They themselves, on their expectations, their assumptions and projections on their policy statement today, said that they were looking at a range for economic growth next year in 2023 of only 0.8% to 2.5%. And that follows their updated and revised expectations for this year of only 1% to 2% growth. So we're essentially going to kill the job market in order to kill inflation. And under a cost push inflationary mindset, I just don't think that's going to work well. So that's my mindset. And what it translates into the commodities, Jesse, is it could really spur the dollar to continue to go on higher.
Well, and that dollar, we've seen that be a major headwind. I know we saw that earlier this week in the wheat market. It was kind of a headwind as well. And you think about maybe the dollar adding itself as a headwind. I wonder how that could work up against, say, a weather market. We're watching a lot of these weather influences in the trade right now. We maybe entered into the weather market a little earlier than normal just because of how tight the global balance sheets are. So as we look at the weather situation now getting into mid-June, and you combine that with maybe a higher dollar and some of this inflation worry, one has to wonder what direction the grains could take here as we move forward, Mike.
Well, I'm really glad you framed it that way, because you're right. We are at a point now where we're hitting demand very hard because of this Federal Reserve policy and the reaction by the bond rates, the bond yields. They are the seed. They're the foundation. They're the nucleus of why that dollar's rallying so much against other currencies. Other currencies could be rallying. I mean, the Japanese yen is at a 20-plus year low right now. The Australian dollar, which is usually a commodity-friendly currency, it's getting hit really, really hard right now. The euro currency is as well. I think this goes back to the demand side of the equation. And at the same time, you brought in the weather market, which is the supply side of the equation. And so it's kind of the worst scenario for the agriculture sector that you could have historically. And I think that's where it goes back to the emerging markets, and it goes back to the commodity indexes and things like that. So my short answer is this is a market you really want to hedge. Even if you just came out of Nebraska with a freeze and several hailstorms and maybe a tornado, and you lost a third of your crop, which I've got clients right now worried they have lost about a third of their crop at this stage after this last 3 weeks. Even with that in play, I think you still want to look at hedges in terms of paper positions and stay away from cash-related sales for right now as we go into the weather market. But take rallies like this that we could be potentially getting ready to have and really lock yourself into a decent floor price.
Mike, you mentioned emerging markets. I want to pull up a chart on the YouTube video feed of the show here today. Walk us through this chart a little bit, comparing the emerging markets and the Bloomberg Commodity Index, and explain to us what you're seeing here and go through some of your thoughts.
Yeah, this is the foundation of this chart is that historically, since the globalization phenomenon from the late 1970s and really kicking into gear with WTO and whatnot, Jesse, into the 90s and 2000s, we have an investment mindset and framework of the investment community that if they're going to buy commodities, it's usually going to be because the emerging markets are growing so quickly. The Brazils, the Russias, the Indias, the Chinas, the BRICS, in other words, when they grow, commodity demand grows. And because of that, that's used as a kind of a mindset of, okay, let's buy into commodities because the emerging markets are strong. So what I did was I put it together an exchange traded fund that's very large called the MSCI Emerging Market Fund. And I overlaid the Bloomberg Commodity Index, which would include oil, would include livestock and agriculture, pretty much all commodities, softs as well. And I wanted to see, since the financial crisis, if that general mindset is true, that if emerging markets are going higher, does that stimulate the Bloomberg commodities and the commodity index buying? And generally speaking, that is what you're looking at. When you see the red line, which is the emerging market fund, drive higher, it tends to support the commodity index funds like the Bloomberg Commodity Index. Notice the big difference was 2016 through 2020, where we had to go through some deflationary time period. But then we played catch up again, and that low in 2020 in the emerging markets was also a major low in that Bloomberg Commodity Index. Now, why is this important? Well, there's two reasons. One's fundamental. Obviously, the biggest emerging market driver is China. They're no longer really an emerging market, but the market really considers them still part of that. If China is weakening, and that's what you're seeing in this 2022 time period where the emerging market red line really fell apart and went sharply lower, that's your zero lockdowns in China. That's your problems in Hong Kong. And that's your money being pulled out of the investment community, by the investment community of the emerging markets, in my opinion. But at the same time, during that time period, you had a sharp rally in the commodity index. That Bloomberg Commodity Index rallied really sharply after early 2022. That's your supply. But what my contention is on this is, and this goes back to the Fed policy, you can't have both at the same time for very long. And you notice the Bloomberg Commodity Index, the blue line, is already starting to eat into that sharp trend line in green that I'm showing there. So that's what I'm watching right now. And if we see that trend line violated on a monthly close, that really takes away the potential for new investment to come in.
Well, Mike, let's talk a little bit as well. Corn today and beans looked like a little bit of spread action maybe there in both those markets. I know we got that cancellation of beans this morning, I believe, on the Daily Wire, and then corn, a little bit of spreading with that old crop July lead month against the new crop. Any thoughts chart wise with some of the action we saw in quarter beans today?
Yeah, beans are on a kind of a red alert scenario right now. Last week it was wheat and it was corn. We had those two commodities, especially the wheat, right up against some major trend lines on the weekly and monthly charts, and they're not far from them, but they've recovered some. Beans are right there now as well. We're eating into the 10-week moving average. We're eating into the uptrending support line on the weekly bean chart. There's also almost an identical uptrending support line on the monthly continuation too, Jesse. So beans are really making me nervous at this point, especially in light of the WASDE report. And that cancellation you bring up, I really wonder if it was China, and I really wonder if it wasn't because China and Russia just had a powwow again, and whether we're starting to see a little bit of trade working as far as using trade as a weapon, as a political weapon, because we're starting to go more toe-to-toe and head-to-head with China in regard to Taiwan. So I'm very nervous about soybeans. I have been all year. And if we have a weather market, yeah, that can take your national yield down. But remember, we've got a 100 million metric ton ending stocks globally, and we are at almost $18 soybeans. So I want to say that we have some weather premium in the beans already baked in, especially compared to the corn and especially compared to the wheat market.
Well, Mike, as well on the wheat market, we see it down a little bit here today. I drove through Southern Illinois yesterday. I tell you what, looking at that wheat crop that's being harvested right now, it looks really good. The windshield view anyway. Now, I know that's not the case in parts of the plains, Kansas, Oklahoma. We've had the spring wheat challenges, and obviously we have the global challenges. But I wonder with wheat here, we've talked before about wheat being the upside leader. Do you think it's still the upside leader at this point, or do you think some of the weather issues are playing into the wheat market right now?
Yeah, you've got a harvest seasonal coming in, and at the same time, you've got a row crop seasonal with tight supplies. And if you do have hot, dry weather, the corn and beans sure can diverge from the wheat market for a time, Jesse. And I think that's a really valid point to make. And we saw that in 2012. The wheat essentially made its high. It was really the corn and beans that did everything by themselves, and the wheat kind of followed laggingly. On the wheat, it's funny you bring that up about Southern Illinois, because I just had a conversation, a pretty long one, with a client down by Olney, Illinois, not far from Effingham. And he said last year was a great crop. This year we're expecting even a better crop. So I think your windshield view is right on target with what they've been walking their fields and looking at. Having said that, I've heard from quite a few clients in the northern half of Illinois and over into Indiana that are pretty concerned about their soft red wheat crop. So I would say I'm going to look at, obviously, the hard red wheat. It's harvesting. We're going to get into full swing if we don't have any rain this weekend. It's really going to go fast. I want to see what we do there in the next few days. I want to see how the soft red guys are lining up. But I really want to see also what the European people are doing too, because we're in that time period for the hard red wheat and the soft red wheat to be harvested out of the European Union. And we're getting there in the Russia-Ukraine time period too. And I think one of the biggest problems that wheat has faced, other than the Federal Reserve and the sharply higher dollar that we spoke about, was the European wheat, the Paris futures market. It's just died on us. We have not had any kind of rally potential at all develop, even though we've had mostly bullish news come out of the Black Sea. We're still talking about a grain corridor. Turkey's now saying that they can help build one, but nothing's been shipped. In fact, Ukraine just came out with some fresh news today and said their exports are down 40% so far in June. They're used to shipping out about 5 to 6 million tons a month. As of this point, they're getting less than 1 million tons a month out the door. So I think the wheat is still a leader to the upside. It's a timing issue at this point.
Now, Mike, as well, we spoke about the Federal Reserve at the top of the show, and now that has come to pass here with the markets, we have the June 30th acreage numbers coming up, and I just want your thoughts real briefly, as we turn the calendar closer to the end of the month, how much is the trade really going to start focusing on what we could expect to see with that June 30th report here overall across the board, and how much is that going to work with a weather market, do you think?
My opinion, Jesse, based upon the last 26 years of doing this, is that if the USDA comes within like 750,000 acres or less than 1 million acres difference between the corn in March and the beans in March versus June, the trade I don't think is really going to do much about that. It's kind of a yawner at that point. It's really back to the yield side. And if we are, today's updates on the weather models, the GFS got drier. And then about an hour and a half later, the European got even drier than that. And it seems as though the GFS is starting to follow the European model into a drier bias, except for maybe like Missouri. But Iowa, that rain has been pulled now in the latest Euro model. And we do seem to be forming maybe a ridge of high pressure that is starting to show up on both models. And I think that really overwhelms the trade coming into the June 30th report if it's still in play. If we're talking about this in 10 days, I don't even think they're going to care about the acreage report that much.
That's a good thought to consider. Let's go over to livestock here, Mike. Cattle had a really strong day here today on Wednesday. Both cattle and hogs maybe had a little bit of doggish trade to start the week, but cattle seem to shake it off. I know you have another chart for the video as well, looking at ground beef with live cattle futures. So I'm going to pull that up because I think this is very interesting and a good place for us to start here, Mike, because, we watch that demand at the consumer level. A lot of folks are buying more ground beef versus, say, your ribeyes or your New York strip steaks just because of price levels. So talk about this chart a little bit and how this kind of corresponds together.
Yeah, this chart would not mean as much to me, Jesse, had we not seen a 5-pound drop in dressed weights on our weekly supply numbers this past week. And now we're 2 pounds below last year at this time. And so far for the daily numbers, we're continuing to see dressed weights fall. Even though females are still a large percentage of the slaughter, we're seeing dressed weights continue to fall. This makes the ground beef demand you're talking about much more important to the live cattle price because, in my opinion, it puts the packers behind the 8 ball more and they need to bid up more. So at the beginning of this week, I talked to clients about the summer grilling season being better than what I thought about it would be after the Memorial Day holiday. Now I'm watching the weekly sales, and you're right, that ground beef is in there. That 73% ground beef at $2.49 is competing very effectively with about every other meat out there. And so now I'm watching the fat cattle against the 80% ground beef, and that's what this chart shows. And with this big shot up in the black line, which is your 80% ground beef at the beginning of this week, it made sense that maybe the live cattle would be pushed and the cash market would stay firm at 140, and the fats in June being $5 to $6 below that would make sense. We need to get up and maybe get closer to the cash price. So having said that and having done that, I am really eager to get into the August marketings and get into the hedges at these price levels and a little bit higher, because USDA's third quarter steer price is 136. August fat cattle are above 137, almost 138. So keep an eye on your August fat cattle for hedges.
Well, and it feels like as well here, and I was just looking at some light cash activity this week, today. It just, like I mentioned, it feels like the cattle market's been kind of doggish, looking for some direction here the last few days, especially with the big drops in the stock market we saw here to end last week and to start this week. So I think that is another overriding factor, is inflation and the worries on the stock market here throughout cattle land and hogs as well, Mike.
I think what you're picking up on, Jesse, rightfully so, is the difference between restaurants and grocery stores. We're really seeing a lot of restaurant data really fall flat here, and consumers are walking away because they just can't afford the gas prices and the tip and the restaurant. And so they're really going to the grocery store again. And I think that's the distinction. And you got to give credit to the poultry prices and the poultry supplies for what we're seeing now too. That poultry price, especially the boneless prices going up here on the breast in chicken, that has really helped us because it's really taken away the ability of pork and chicken to compete with beef at this point.
Mike, any thoughts on the hog market? July taking over lead month here today. Strong day there, up 165, 108.27 at the close. Any thoughts with July taking over lead month or anything in hogs in general?
Yeah, I'm not sure that the hogs have a lot of upside, Jesse, but I think they're very well positioned at this point in the prices. I'd be surprised to go below 100 this summer in the hog contracts. And I say that in part because China, it seems their hog prices are starting to firm up again because their poultry prices, in some cases and in some areas, their poultry prices are hitting 1.5 year highs right now. So I think the similar dynamic is happening in China, maybe shores up our export market a little bit as we get into July and August especially.
Well, Mike, we covered a lot as always today, sir. Any final thoughts you have for us real quick?
There's going to be a lot about the Federal Reserve. There's going to be a lot about the dollar. It's down sharply as we go off the air here today. So sign up for a trial. Hopefully we can work together either as a subscriber or as a client. Go to globalcomresearch.com and sign up today for a trial and see if we can't help your marketing plan.
Globalcomresearch.com. That is where you can find it very easily. With that, Mike Zuzolo with Global Commodity Analytics. I always appreciate the time, sir. Thanks for joining us. Have a great week, and we'll talk to you next Wednesday.
Thanks, Jesse. Enjoy your vacation.
I will do the best that I can. With that, Mike Zuzolo, Global Commodity Analytics, and that's going to do it for the show here today on this Wednesday, June 15th. Find us, markettalkag.com. I'm Jesse Allen. Have a great afternoon.